It is totally normal to feel intimidated or scared about something that we don't really understand because it's new. And this is especially true when the majority of the information we have available about investing comes from financial institutions where it's in their best interest to make you feel like it's really complicated and really hard so that you pay them to manage your investments for you because that makes them more money. The reality is the stock market is actually really simple and making money is really easy. And while I built a lot of my initial wealth with real estate in my 20s, like that's how I got to millionaire status at 30 years old, I still recommend the stock market for 99% of people because there are less barriers to entry, meaning you can get started with less money, you don't need a lot of time, and it quite literally just builds you wealth and makes you money while you sleep. The two main ways that you safeguard your investments or prevent yourself from losing money when you invest is number one, understanding market cycles, and number two, diversification. I want you to think about the stock market as a pendulum, okay? It's going to swing from really great to really bad, to really great, to really bad. It doesn't really spend a lot of time in the middle. And these swings can seem really scary if you don't understand that they are normal and natural parts of the cycle. After a bear market where things are really bad, always comes a bull market. And after a bull market where things are really good, always comes a bear market. A correction happens on average once every 2 years. But this doesn't mean that everyone loses all of their money every 2 years. It just means for a period in time, the investments that you have decreased in value, but eventually the market as a whole has always gone back up. This is where diversification comes in. Basically, diversification is not putting all of your eggs in one basket. This is why I don't recommend stock picking because nobody knows what companies or what industries or even what countries are going to do best in the future. So instead of putting all of my money into one thing, I spread my money out. This reduces my risk and increases my chances of making money. Now, another way that you diversify is not only by what you purchase, but also over time. There's a strategy called dollar cost averaging where you actually put in small amounts of money over time. So sometimes you buy when prices are higher, sometimes you buy when prices are lower, but eventually it evens out. And there was actually a study done by Vanguard looking at historical data that says if you had a properly diversified portfolio, if you invested for at least 20 years, your risk of losing money would drop to zero. And this is why I say don't invest money that you need in the short term and make sure that you have your financial foundation set before you start investing. Now, what do I mean by that? A lot of people lose money in the stock market because they make bad decisions. They cause themselves to lose money. Some of those bad decisions are putting money into the stock market that they need in the short term, not understanding that the market is very volatile in the short term, meaning prices go up and down. And then because they don't have their financial foundation set, they put themselves in situations where they have to sell. If you have to sell when the market goes down, that means you can't ride the wave back up. That means your action of selling is what has actually caused you to lose money, not the stock market. Making money is great, but not losing money is even better. So I talk more about market cycles and how to safeguard your investments and how to create a diversified portfolio in our free investing masterclass. If you want to learn more, you can grab a spot on our website under freebies.